This is Andrew Stotz of Stotz Investment Research, looking at Singapore, which I describe as still cheap, but for a reason. Let's take a look. There's 4 different ways I look at the country, and first let's start with GDP in the upper left-hand corner. We can see the GDP of the country in the last 4 quarters that have been released grew by 2.2%. So that's relatively slow growth. The driver was basically only exports. Well, it is a pretty significant exporter. Exports grew by 15.4%, and they account for 27% of GDP, meaning they contributed 4.1% to the overall GDP growth, so a major component. The laggard was investments and private consumption, which are a pretty strong drag at this point. Now let's take a look at the overall country profile and what's going on there. First of all, the country has about 6 million people right now. The average per capita GDP is almost 53,000 US dollars, which puts it at the top of the world as one of the top countries as far as average per capita GDP. And also, market size relative to GDP is 205%. So it's a much bigger market than the overall GDP, but that's usually the case in a country that is relatively small. There's about 712 listed companies in the market. Now let's take a look. It's among the lowest PEs in Asia. Right now, forecasts by analysts are expecting about 14.4 times PE in 2017. But when we look at it relative to previous and estimated earnings growth, it doesn't look that attractive. In fact, previous earnings growth has been negative. The last year was minus 8.2. Analysts are expecting about 7 over the next 2 years, but analysts tend to be optimistic. So we could say that maybe Singapore has 2% growth or something like that in 2017. So not particularly fast. The price to book at about 1.2 is getting cheap, but it's unlikely that that's going to go up anytime soon. And of course, ROE is below 10%. So it's not necessarily a high ROE market. The one good spot is it does have a very high dividend yield of about 3.6. All right, let's take a look at our 4 elements. And these 4 elements, we do an overall score. That's the blue bar. And the score in this case is a 2 when ranked against other countries in Asia. Then if we look at it, we can see that it's second least attractive in Asia. The fundamentals are second lowest because of ROE, which is very low. Valuation multiples are low and dividend yields high, as we just saw, so not bad on a valuation perspective. If we look at momentum, well, poor earnings and price momentum is a real drag right now. And there's not necessarily, in the analyst forecast, there's a bit of expectation of earnings momentum accelerating. But as analysts tend to be overly optimistic, that just may not be realized. And finally, risk is moderately volatile. Finally, let's take a look at the sector performance to understand a little bit more. The first thing we want to understand is that the industrial sector is 28% of the market cap. Real estate is 22% and financials are 19%. So the best sector in stock, well, Infotech was best and Venture Corp was up 25%. The worst was energy, with down 8%, with Golden Energy and Resources down 21%. So there you have it. Singapore, not a particularly attractive a market at this point in time in Asia. All right, so get access to additional research and articles by joining our free newsletter. It's at becomeabetterinvestor.net/join, and I'll see you there.